Monday, June 12th, 2023, Monaco 64, home of alternative economics and contrarian views. So this week we've got a couple of important events for the markets. And why do I air quote the important events? Well, because I think it's just noise. We need to look at the bigger picture and why the current system we have of central banking, of fiat currency, of what they call price stability, actually creates even more currency debasement or inflation. And I'm going to prove that to you today with some historical data. Before I start, I'd like to let you know of a couple of specials in the precious metal space. First one is from Gold Investments. They still have the 1 ounce gold Krugerrands on special. They're only 1% over spot, and it's valid till today at 4:30 p.m. London. After today, it's finished, that special. And if you use my promo code Monaco64, basically you're paying for gold at 0.5% over spot. So I think it's a good deal. I've taken advantage of it. And the second one is from Glint. Glint, of course, is a warehousing company for gold, but they also give you an app and a MasterCard that allows you to spend that gold. Well, their special is that you get 50% off vaulting and insurance fees for the next 12 months if you use my referral code MonacoV50. This offer is only valid till the 14th of July, so you still have a little bit of time if you haven't gotten a Glint account. So yeah, back to inflation, CPI, and we hear central bankers talking a lot about price stability, especially the European central bankers. It's always their mantra. We want price stability. It makes it seem that price stability is a good thing, that it keeps the currency steady and stable. But I would argue that it keeps the currency continually being debased. And currency debasement is what inflation is all about. Currency debasement is when you inflate the currency, and they do it by creating fiat currency out of thin air, and the central banks are allowed to do that. And it just dilutes all the other currencies, all the other currency out there that's been created before. It's like putting water in the milk. It dilutes the milk. It's like putting water in wine. It's like taking the silver out of the denarius, like the Romans used to do it, and put base metal. But deep down, I think the free market and sound money is the best way to ensure the stability and the non-debasement of the currency. We need honest weights and measures. We need to go back to a world where money is a weight in grams or ounces or kilos or whatever, of course, of gold and silver. So I'm going to show you this chart that I saw a few months ago, and I thought it was really interesting. And it's actually from the Office of National Statistics from the UK, and it goes back to 1810. And if you look at the fluctuation in the inflation rate as they calculate it back in the 19th century, it was wild. As you can see, it was up and down like a yo-yo. And I think the last time that we had this kind of yo-yo up and down action was around the time of World War I and towards the end of World War I, as you can see. So you'd think, well, the 19th century, the Victorian era must have been a horrible time. Look at all that fluctuation. Well, despite the fact that we did have the central bank, the Bank of England back then, and I'm not like trying to justify the Bank of England. I think central banks they enable governments to create a lot of crises, wars, and stuff. It's like an instrument of the globalists. But be as it may, in the 19th century, compared to today, the Bank of England and even the government, they were much more market oriented. So yeah, you'd think, well, what a horrible period. But then this instability and inflation. But you look at the Bank of England inflation calculator, and you look at the period from 1810 to 1914, and it shows that average inflation was minus 0.4% a year. So you'd think, wow, that was horrible. But it wasn't, of course, because the 19th century was a century of a lot of progress, industrialization, all the world's fairs, and Britannia ruled the waves. And even in the United States, you had a huge industrial development, especially after the Civil War. So as you can see, the pound became stronger. It bought more. You only needed £6.81 to buy what you needed 10 pounds back in 1810 and in 1914. So what I'm trying to say here is that the market took care of things, and it didn't matter because you had sound money. Sound money was a way to gold and a way to silver. The government couldn't inflate, and if the system was inflated one year, it would deflate the next year, as you can see here. So why have we gone from this instability in inflation and long run really low or even negative inflation to a period now where we always have high inflation, relatively high inflation? We never see negative CPI. I think what changed everything was the Keynesian fallacy and the two world wars and the inception of the welfare state, not just in the UK, but also in the United States with the New Deal. And the goal now is to make sure we didn't have negative CPI, or if you want to call it deflation, that prices were maintained around 2 or 3-4%, because they wanted to basically rob the middle class, I would say. And you can see here the UK inflation since World War One. There's been very few periods where it's gone negative, and it adds up. It compounds. But back in the 19th century, it couldn't compound because it was every time you got a spike in inflation, you got the next year or so, you got a deflationary period. And over time, that was a good thing. It allowed the market to function, to allocate resources. And nowadays, that's gone out the window. And unfortunately, every country is a Keynesian experiment these days. Government is always supposed to help everyone and everything, and I think that's the problem. And I've got some data here from the Minneapolis Fed, and if you go back to 1943, which is 80 years ago, I've counted, and you can count in one finger the years that the CPI in the US was negative. So it was 3 times, so out of 90 years. So this is what I'm trying to say here. Yes, we're going to get CPI tomorrow. It's supposed to drop from 4.9 or something to 4.1. And everyone's going to cheer. And they're going to say, oh, the Fed's got control of inflation. But no, the Fed's job is to inflate. The problem they had is that they started inflating too much for people to notice. So they need to keep it like at 2-3%, and people don't notice and they don't complain. But at the same time, they're the analogy of the frog. They're being boiled to death without knowing it. And the Fed wants that to stay like that, because central banking and the fiat currency system is just a great wealth extraction mechanism from the general public to the top 0.1%, I would say, to the bankers. So, and it doesn't really matter as well, does it, what the Fed does in terms of interest rates. I think the majority of people economists surveyed, expect the Fed to keep rates unchanged on Wednesday, the 14th. And the other thing I would say about these CPI numbers or inflation is that they go in cycles, and you can look at it in the 70s, how they rose up until 1974. They came off in the next couple of years from 11.1 to 5.7. So people were probably cheering back then. But then they rose again from 1976 to 1980, from 5.7 to 13.5. So I think it's far from over, this inflationary pressure. I think the Fed has lost control of it. And yes, it might come off in the next few months, maybe to 4 or 3%, but it's set to go back up again, because it takes a very long time to disinflate. And even when they do disinflate, they're gonna keep debasing the currency. And that's why over the long term, there's nothing better to have than real money. The money that you had in Victorian times, in the 19th century, up until World War I. That was gold and silver. It wasn't an investment back then. It was just money. Nowadays, it's acting as an investment because the fiat currency is so heavily debased. So that's what I wanted to talk about. And I'm going to recommend a book before we go look at the markets for you to understand better the basics of money and currency. And I've recommended this many times, but hopefully we keep getting new subscribers. And it is What Has Government Done to Our Money by Murray Rothbard. And you will understand why they can inflate the system by reading this book. And it's not a long book. You can get a free PDF, which I'll put a link to below in the description, or you can buy the book as well. I'll put a link to the Mises.org website. You could buy it there, or you could buy it anywhere you want. So it's 8:24 a.m. London time. We're going to start with the price of real money versus fiat, i.e. gold and silver. We've got gold at 1960. That's virtually unchanged. The high's been 1962, the low 1954. Silver's down 18 cents at 24.10. That's down 0.75%. The low's been 0.05 and the high 33. The stock market futures, the index futures, the Dow's up 1/8%. NASDAQ 100 is up 1/3, and the S&P is up 1/4. So why is the stock market still doing relatively well? Well, because the Fed has basically stopped QT since February. There's been a net, it stayed pretty much, we are pretty much where we were back in the middle or beginning of February in terms of the balance sheet. So they're not really tightening anymore, and that's why the stock market has done well. To the currencies, we got sterling down slightly at 125.70. The euro is unchanged versus the dollar at 107.50. The dollar is up a bit versus the yen, 139.50. And to the other currencies, Aussie dollar is up slightly at 67.50. The dollar is pretty much unchanged versus the Canadian dollar, 133.33. And the Kiwi dollar is down 0.2 at 61.19. To the general commodities, we've got WTI crude down quite a bit here, down 1.7%, just above 69. Brent is down 1.6 at 73.50. Platinum is down $6 at 1,005. And high-grade copper is down 1.2% at 374.70. I think there was some Chinese economic data that weren't that good, and maybe that's why commodities have come off a little bit. And now let's check what I think are the most important markets if you want to know what's going on in the economy, and that's the government bond markets. We're going to start with the UK gilt market, the government bond market. The 2-year yield is back above 460. We're at 461. And I think a lot of the mortgage lenders, banks, are going to increase their rates today. And we need to keep an eye on this, because if we break 475, we could see the mortgage providers pull a lot of deals even more. They pulled quite a few last week. And it's going to get harder and harder for people who have big mortgages, who took it a few years ago. And you have to understand, in the UK, mortgages are mostly like 2-year and 5-year fixed. Very few, there's no such thing as a 30-year fixed mortgage. Just look at the US Treasury market. The 2-year yield is up 3 basis points at 463. And the 10-year is up 2 at 377. But still, the curve is heavily inverted still, not just from 2 to 10, but also like from 3-month to the 10-year. We are at 529 in the 3-month and 376. That's a really bad sign. I think there will be a recession coming when we go from disinversion to zero. That's usually when we are at the height of a huge crisis or recession. So with that, I'm going to wish you all a very good day. Take care. Bye.